All right, it is Jeff Mackey live. I'm Spencer Israel, Stock Market TV. That's Jeff Mackey from the Mackey Portfolio. Jeff, we talked a lot at the end of the year how it was Christmas for you. The whole month of December was Christmas. November was Christmas. But also, this week is Christmas too because it's the biggest retail conference of the year. So Christmas just keeps on going for you, I guess.
Yeah, or at least one of them.
Yeah, one. That's right. You have multiple.
Well, Christmas technically, kind of, religiously, you can argue that Christmas goes for actually 2 weeks after the 25th, but spiritually, to me, it goes through Valentine's Day. But that's beside the point. That's between me and my neighbors who want me to take my Christmas lights down. But yeah, ICR was took place in Florida. It's a shindig, a gathering, if you will. What it leads to is a lot of pre-announcements. Because the companies presenting have to present kind of material, non-public information. So they disclosed that. So we heard from a bunch of different companies about how their fourth quarters actually went, how the holidays went anyway, and some keynote speeches that kind of laid out the bigger players in the industries, their plans for the year, kind of where they see things going, and a lot of scuttlebutt, a lot of gossiping. And so it was just kind of a fun gathering that I choose to stay away from, but I love talking to people who go there and I pick up the gossip and the rumors.
This is just a really large investor conference specifically for retail, right? And it's every January.
Pretty much, yeah.
Right. Okay.
Yeah, it's consumer names, so it's not just me. It's restaurants. It's anybody. It's my group. These are my people. Anyone who interfaces with customers is there and kind of talking about the latest stuff.
All right. So you could call it the Super Bowl of retail. You call it retail Woodstock, whatever you want to call it. It's done now. Let's talk about your biggest takeaways from what was discussed there. We'll start with Walmart. I guess you said they gave the keynote. What did they talk about?
Well, they gave the fireside chat or whatever you want to talk about. It's the most widely watched. This thing is a juggernaut, Spencer. As you know, it's. I think we're both long and kind of it's ambivalent about it. At least I usually am. But now all of a sudden they're breaking out, so I feel like a genius. The question all last year was what it seems expensive, to be polite. But they kind of laid out some reasons why, and what they're thinking are it trades like a tech stock because more and more it is becoming, in fact, a tech stock. We've spoken time and again about how the discount shopping experience online really is due for a brush up. It needs to be freshened up. It needs a makeover, a do-over, if you will. Walmart came out and they said, well, that's exactly what we intend to do. They announced yet another deal in AI with the Googles. Alphabet, whatever the hell they call them. So, but the point being that they're going to make it easier to shop for their zillion and five different items. You combine that with the idea that you're getting into much more automated delivery, and Walmart has really joined Amazon as a tech company in drag. Amazon, of course, trades like crazy. They report, I think, in the next couple of weeks they'll trade off AWS already. Walmart trades off retail. But this is important because it's going to drive margins. And this is going to be a make or break year for a lot of these AI companies. If AI is going to be proven real, it's not going to come down to whether or not Meta is going to dump a ton of cash into it, because here's a spoiler, they are. But it's going to, the real, where the rubber hits the road is whether or not companies like Walmart can make money off it. And that's going to be answered this year. And I think Walmart has kind of the inside edge. Stock making 52 and all-time highs. Again, that's pretty impressive for a company that was founded in 1961, went public in 1972, all-time highs. Not bad. The Broncos are in their Super Bowl. You know what? The Walton family, they're having a good year. And this is part of the reason why.
So you're in the camp that Walmart probably needs to be re-rated or recategorized. I mean, I guess it kind of already is. It's at all-time highs here. This is almost $1 trillion company. But
it's kind of embarrassing that they're not $1 trillion company, right? Because if you think of them as a retailer, that sounds absurd. But then you compare them to these other companies, it's like freaking, what's Tim Apple done for us lately? Not very much at all. I tell you that. And so if the largest retailer in the world can't be $1 trillion company, well, what the hell? I think it's the world that's at fault, not Walmart. But yeah, clearly, you expand the margins on $700 billion in retail sales and your margins are about 5%. You make that margin 6 or 7%, all of a sudden it's leveraged city, baby. And there's a long way to go. If your distribution center doesn't really require people or necessarily any kind of guys with clipboards roaming around or many workers at all. You can make an order and it's not going to be touched until someone drops it off at your door. And if they use a drone to deliver it, well, no one touches your product between the order and when you get it in your greedy, hot little hands. The margins on that are huge. The scale is huge. And that starts happening this year. It starts happening sooner than people think. And you mentioned that again, the shopping experience from a discount store level, if you go to Walmart and you say, I want to buy light bulbs, they can't just start listing 500,000 different light bulbs for you. They got to do a better job than that. That's one example, but they should know kind of what you want, when you want it, when it's going to be delivered, and get customers more used to just accepting delivery and kind of automating their lives. It adds value for the consumer and it drives margins for Walmart. And that's why the company's trading at 45 times earnings.
Since you mentioned 45 times earnings, I will add that Walmart is more expensive than Amazon. So let's just remember that, right?
Maybe they deserve to be. Maybe it's that focus on retail that people are liking.
Yeah. All right. Moving on. Takeaway number 2. Lululemon, their fourth quarter apparently not a total train wreck, and the stock is, off its lows. So that's good news. What should we think about this?
You go down long enough and eventually everything starts looking like up. The fourth quarter, I wasn't sure if a disaster was priced in or not. This was one of my co-favorites for turnaround of the year. I've got 2 of them that I'm actually willing to play. And retail, just like every other industry, you don't want to catch a ton of falling knives or you tend to look like it's not pretty. It's ugly. And so you choose your spots here. And I think Lulu's going to bottom. And I think they already have. I think Target also is going to be another one. But Lulu came out and they said, listen, it's the fourth quarter. Wasn't that bad. Now, it doesn't really matter. They just fired the CEO. They've got activists involved. Our friend Brett Conrad's involved with that. It's the former Chip Wilson CEO coming in there, exerting some muscle, flexing a little. I've got 9% of the company and I got a bunch of private equity guys on board with me too. So they're taking board seats. There's a lot of different things this company can do to just operate better. I didn't think they had even a mediocre fourth quarter, and it really wasn't. It was within range of where they'd guided to before, but it's better than missing. But the real turnaround play is going to be if they can start kind of innovating product. They have a lot in common with Nike. Nike also reported a not completely horrible Christmas. I think they have a lot more heavy lifting to do than Lulu does. I don't know that Lulu is all that broken. I just think they need a bunch of product refresh.
So this is going to take time. You mentioned new CEO, so this will take time.
I mean, we mentioned it when we were talking options before. It's I like my catalyst kind of vague and out there in the future, and so it's going to take time. But this is good. We have a new, there's nothing more encouraging than a new CEO. Once the actual guy becomes the CEO who's been here a while, expectations tend to go up. So it's these ambiguous catalysts for the future are good.
All right. What about the controversial stock of the summer, last summer, Cracker Barrel, which everybody went, everybody cared for about 2 weeks, and then we decided, oh yeah, it's Cracker Barrel. We don't actually care about this company or the stock, and we all went back to our lives. Anyway, they're still doing their thing. So what did they say?
They're doing their thing, and their thing is kind of a low rent sort of icky thing, but it's their thing. They're serving you cornbread and gravy or whatever. I think people smoke at the tables. I'm not sure. I kind of am mostly envisioning Cracker Barrel because I don't go there often myself. But they said that they're getting better customer surveys than you would think. The mood has kind of changed. They finally outlived this vibe. Now I would argue, and the scuttlebutt, the gossip around the sewing circle where all the retail folks hang out, was that there was not, in fact, any real organic outrage in the first place because they got rid of the old redneck sitting against the barrel there up in front of their stores. That was never a great logo. It wasn't a storied logo. It wasn't a piece of American history that anyone was trying to shut up. A lot of the tweets and the cultural outrage came from just kind of spam bot farms out there. And so there are suspicions that some hedge fund shenanigans were being played with this, and that contributed to a lot of the outrage. In any event, it's not, there's some blocking and tackling that the CEO can do just to kind of make it a better experience. The stock seems to be kind of coming up a little higher. You can take this thing to 40, at least 45 before you get to the 200-day moving average. It's, it is arguably really oversold, and they're not going out of business anytime soon because, again, the outrage was kind of fake in the first place and they backed off as fast as they possibly could. So we're seeing just a slight performance improvement, but with a stock that went from 70 to 20, low, just kind of the low 20s on largely not actually organic kind of hatred for getting rid of old Remus there sitting in front with his shine against his barrel, just being all grumpy. I think that this actually looks kind of intriguing for those of you who don't like Target or Lulu in terms of your turnaround plays. But they got a little chatter at ICR.
All right. You know who else got chatter, and not in a good way, is the mall stocks. And I think we have Abercrombie & Fitch to thank for that. What the heck do they say that was so bad?
Well, everyone's a little skeptical about these guys all the time, and they keep being worried. They're worried about Hollister. Abercrombie is two different companies. It's Hollister and then the name brand Abercrombie. They need to kind of get both those working at once. They haven't been able to. This stock went from 60 to about 130 in a heartbeat, ripping out the souls of a lot of people who were short. It's not an expensive stock, but they reported not great comps. Nothing too exciting. AEO reported that same morning, and it was Monday that all this came out, again, ahead of this conference because they've got to release their quarters. AEO was really solid, not super spectacular. It wasn't another guide up. They said that their comps were high single digits, which is where they said they were before. So they reported the great quarter that everyone expected. But both those stocks opened much lower. I kind of expected Abercrombie to take the entire group with it because we've had such a heater since November. Today, you're seeing some softness in the entire group. That's kind of overdue. You don't want this straight shot. And so it's a little bit of tradition. We also talked last week about kind of taking in our bets a little bit. If you go to that next slide, you can see the streak that these stocks have had for the last 6 months.
Wow.
Yeah, they were due for a correction. Victoria's Secret doesn't typically go up 227% in 6 months. So
really? That's
yeah, I don't know.
You sure?
Yeah, it depends on how the show goes, how people are liking their angels. But they are still selling pretty well. The multiples aren't crazy. They're all due for a pause. And in the post-Christmas, post-ICR kind of world, even if I call Valentine's Day still Christmas, it's time to just give them a breather, have a smoke if you got them, relax if you need to. Abercrombie probably not going anywhere, but I think that party's over. When you drop a ball from 500 feet, it's going to bounce a few times. And I think that's what we saw with Abercrombie. That bounced pretty hard, pretty fast, and just got a little bit ahead of itself. So, but the good news is that the stocks are showing some resiliency. That's, which is great for what it's worth. It's also kind of a graceful exit for people that just ended up too long. A lot of portfolios got really skewed. When AEO goes from 20 to almost 30 in a nice one fell swoop, you all of a sudden own a lot of American Eagle.
This goes back to what you're always saying with retail stocks: date, don't marry.
Right. Yeah. Don't fall in love with them. They'll break your heart. They'll break your heart, Spencer. It's like I tell my kids, you can date a few. It's okay. It's okay to have a kiss or two along your way before you find true love. Most relationships end. Otherwise, you wouldn't have the love of your life. That's
true. All right. Well, let's wrap it up here with Stitch Fix. This is one of your favorites. They gave a fireside chat. What they say?
There was just a lot of buzz. I think people, they're still in that phase where people don't really believe in them just yet. But man, they have a plan and they've got an impressive CEO. They had the same leadership in place for a long time. Got a new guy in there now who came out and he made a lot of sense. They're playing for the long term. Their cash flow is just fine. Thank you. They're achieving growth in men's already, which is a key segment for them. It's really hard to sell clothing to men. And go figure. I'm wearing my Venezuelan despots jersey today. That's how men buy clothes. It's like, hey, that guy that they took out of Venezuela, he looked pretty cool in that Nike. So I ordered it with my little Vikings logo. That's how men dress. Does my wife like this? No, she doesn't. She would prefer I buy things from Stitch Fix. So would a lot of wives out there. Our man Sean loves them. It's a good product. They're going to kind of go to growth positive this year. I think that'll be a point of inflection for the stock. That's why I like the company. As we saw with Warby, which we've mentioned a few different times, these companies that got left for dead post COVID, you hang out long enough and you actually grow into the valuation. There was nothing wrong with Stitch Fix as an idea. It just got really super expensive. The idea of a subscription online order, it suits itself really well to AI. In a non just hype way, it actually makes sense to help people dress this way. And once people subscribe, they tend not to quit. And what the CEO said that was intriguing and also really good for long-term investing types was that he's not really interested in just sort of inflating the numbers. Now, if you want to just day trade and whip it around, that's not what people necessarily wanted to hear, which is why the stock is still going to be a bumpy ride. But if you're a long-term investor, what you want is real organic growth, because what they have now that they didn't have before is a much stickier user base. Once people kind of get on board with this, they tend not to leave. And that's how they're growing the company now. And so with a CEO who's not brand new, this guy's been there for a couple of years now, you want them to deliver what they promised. You had a 3-part plan: 1, stop the bleeding; 2, kind of let's rationalize the company, which usually means we're going to get rid of the stuff that doesn't work. He's done that. And 3 was return to growth. Well, he did steps 1 and 2 already. It's return to growth year. And I think he impressed a lot of people. Again, just a lot of chatter, a lot of scuttlebutt. A lot of rumors out there that people were kind of favorably impressed who hadn't really given Stitch Fix much thought before.
There was Stitch Fix in the bad news is already priced in category.
Oh yeah, it's death is priced in. I mean, it's we don't have the long-term chart, but it's just, let's say AI, it fell and crumbled but they're not out of business. And so, these companies that come back from the dead, they usually come back with a vengeance.
I'm still here. All right. Speaking of still being here or not being here anymore, let's end this show by pouring one out for Saks Fifth Avenue. Jeff, this is just another in a continuing series of recent retail bankruptcies in the last decade or so. So everyone cheers. Pour one out for Saks.
Man, this was a dumbass deal. It's everyone wants to like to clump this into the department stores are dying category. And believe me, I'm not in favor of more department stores. I'm not sure how they lasted this long just as a group. But Saks, they got bought out last December, the 2024, in a debt deal that, it died 45 seconds after it was released. The bank just kind of stuffed the debt out there, and it was trading at like 80 cents on the dollar almost immediately. No one really gave it much of a chance, and sure enough, they failed quite miserably. So now they're not going anywhere. You'll still have Saks across from the Christmas tree over there by Rockefeller Center in that big overdone building. They used to have a ski slope in there long before that.
I didn't know that.
Yeah. It was crazy. It was a fancy different day in New York. But they're not bringing the ski slope back, which is probably good news, or at least they didn't mention it. But this is just another bankruptcy. They got wildly over levered. I'm not sure why retailers do this. It's not a business that lends itself to huge amounts of leverage, but it's a story old as time where Macy's used to be about 50 different department stores, and they rolled them all up. Went bankrupt almost immediately and been rebuilding since. Saks will still exist. Someone's going to buy them for pennies on the dollar at some point. So we can pour one out for them.
It's a great American brand along with Neiman Marcus and
now it's all one great American brand with Neiman Marcus. So they brought the guy from Neiman's back in, and those were two just overhyped, clever, ridiculous.
Bergdorf Goodman, right? They're all one and the same. They're all great American brands, right?
Yeah. It's that only in a PowerPoint slideshow run by just kind of mind control, just super Spocks. Can you actually make it sound like a good idea? We've got one lousy company. We're going to marry it to another lousy company, and that'll give us synergy. We'll have synergy between these two lousy companies. That doesn't really work that way in the real world, and it didn't work that way for Saks. But, pour one out for them. Hopefully the building will stay, and maybe they'll put the ski slope in, and we could have a little ski vacation there and right there on Fifth Avenue.
All right, to find out what stocks Jeff owns in his portfolio and what options trades he's making to add some juice to his returns, that is in the link in the description if you want his free note as well. The link to sign up is there as well. Jeff, we will talk to you not next week. I'll talk to you in a couple of weeks. And if you want to do a show next week, I think you can just hop on here by yourself. But,
Yeah.
if not, we will see you in a couple weeks, and keep on keeping on, man.
I will. You too. Enjoy Miami, my friend.
Alrighty.
Go Hoosiers.